This LOS is explain appropriate analyst adjustments to a company's financial statements to facilitate comparison with another company. So now we're looking at analyst adjustments to reported financials. There's a big section in the text. This is just meant to be a summary of what's in the text, but you need to go back and look at the curriculum and go through these items in a little bit more detail. So 6.1 is a framework for analyst adjustments. 6.2 is analyst adjustments related to investments. If two otherwise comparable companies have significant differences in the classification of investments, analyst adjustments may be useful to facilitate comparison. Analyst adjustments related to inventory, well, we've seen that in previous LOS. To recast inventory values for a company using LIFO, reporting on a FIFO basis, the analyst adds the ending balance of the LIFO reserve to the ending value of inventory under LIFO accounting. Remember, LIFO is only used in the US under US GAAP, okay? Not permitted under IFRS. To adjust cost of goods sold to a FIFO basis, the analyst subtracts the change in the LIFO reserve from the reported cost of goods sold under LIFO accounting. And again, we've gone through all that in previous LOS. Analyst adjustments related to plant, property, and equipment. There's analyst adjustments related to goodwill, and there's analyst adjustments related to off-balance sheet financing. Again, because these reading and these LOS are based on application, we're pulling back some questions that we've seen previously. So an analyst is evaluating the balance sheet of a U.S. company that uses LIFO, accounting for inventory. The analyst collects the following data. So the inventory reported on the balance sheet, end of 2005, 500,000, end of 2006, 600,000. The LIFO reserve, end of 2005, 50,000, end of 2006, 70,000, and there's an average tax rate of 30%. After adjusting the amounts to convert to first in, first out, the FIFO method, inventory at 31st December 2006 would be closest to A, 600,000, B, 620,000, or C, 670,000. I think by now that question should be pretty easy. C is correct. To convert LIFO inventory to FIFO inventory, the entire LIFO reserve must be added back. So it's just the 600,000 plus the 70,000 equals 670,000. You don't need the tax rate. You need the tax rate if you're looking at the adjustments to net income or retained earnings. Okay? Another quick practice question. Which of the following is an off-balance sheet financing technique? The use of A, capital leases, B, operating leases, or C, the last in, first out inventory method? Again, I think this is another pretty easy question. B is correct. Operating leases can be used as an off-balance sheet financing technique because neither the asset nor the liability appears on the balance sheet. Inventory and capital leases are reported on the balance sheet. And one last practice question to finish this LOS. To better evaluate the solvency of a company, an analyst would most likely add to total liabilities A, the present value of future capital lease payments, B, the total amount of future operating lease payments, or C, the present value of future operating lease payments. Nice little question to end on because you just have to be careful with the wordings. C is correct. The present value of future operating lease payments would be added to total assets and total liabilities. Because if you have an operating lease and you want to compare it to if the company had the asset and the liability, you're going to use the present value of the future operating lease payments. If it's a capital lease, A is wrong because if it's a capital lease, you've already got the asset and liability on the books. And you're not looking at B, you're not looking at the total amount of future operating lease payments. You're using a present value technique. So that's why I thought that was a good little question. And that's the last slide for this LOS. Thank you.